Do you want to organize your finances, create wealth, and transform your wealth into a legacy? It's time to start today.
Welcome to Octane. My name's Andrew Wall. I'm the managing partner of CPA for IT.
And I'm Rachel Stedman, head of customer care.
Our new podcast designed to give your small business the fuel it needs to succeed. Hello, everybody. We're back with another episode of Octane. Once again, I'm joined by my amazing co-host, Rachel Stedman.
Hi, Andrew.
Hi, Rachel. I hope you had a great week. I'm excited to talk to you today about specific accounts and specific deductions people can make. And we're talking today about percentage of use accounts.
Yes.
So these, to be honest, I guess when you move an expense from one category to another, it might be better from a reporting standpoint so you understand where your money is going, but ultimately it doesn't change the taxes because, both categories are 100% deductible. There's a couple of exceptions to that though, and those are what we call percentage of use accounts. Rachel, do you mind breaking down a little bit what a percentage of use account is?
Sure, definitely. I mean, normally what I like to tell clients is when we're looking at a business expense, right? Every cost which you incur for business purposes, you get to use that as a deduction, okay? The normal rule of thumb is that you do get to deduct 100% of your business expenses, with the exception of a few. So there are really about four main ones. So your home, which is always going to be based on the use. So based on the square footage of your home to the ratio of the rest of
your home office specifically, I guess.
Your home office, that is correct.
It's not that your home is deductible, unfortunately.
That is true. Your automobile, that's another one, that's a percentage, okay? The meals and entertainment, it's a bit standard. So you don't get to deduct 100% of that. It's always going to be a flat 50% that CRA allots for that. Of course, we have different tips that we've kind of discussed in prior podcasts of how to kind of switch expenses from meals and entertainment, which is 50%, over to advertising, which is 100%. And another one, which is a bit tricky, is items that are considered an asset. Okay, so although technically you do deduct 100% of that, it's very important for clients to know the difference between what's considered an expense and what's an asset, because then that has to be depreciated. So although you do incur the cost in 1 year, and yes, you are eventually deducting 100%, on the financial statements, you're only deducting the depreciated value over an extended period of time. Okay.
Right.
The depreciation on the assets and the meals and entertainment, that's pretty standard. But then it's the home office and the automobile, which has that percentage, and that percentage is unique to each individual.
Right.
A lot of clients like to tell me, well, what percentage should I be deducting for my home, or what percentage should I be deducting for my automobile? And there is no clear cut across the board what you should be deducting. It is based on your actual usage. And that does require clients to really pay attention and make that calculation, do that calculation, right?
And how do they do that calculation? Let's start maybe with automobile expense. How do people figure out what their percentage of use is? And are there any tools that can make that process easier?
Yes. So I think this is the one that clients dread the most. I mean, your home office, it's pretty standard. Once you do it one time, it's okay. But it's the automobile that's ever changing, right? So I mean, yes, you can think about it at the end of the year, we can calculate that X is your percentage, but you have to be tracking that throughout the year. So essentially, anytime you utilize your automobile for business purposes, the kilometers which you are utilizing for business purposes, that has to be calculated to determine the percentage of your auto for business. So it could be as simple as, most clients think about it only as my commute from, their commute from their home office to their client sites, right? And which, is correct. But I know a lot of clients now, because of COVID and a lot of people are working from home, they always like to say, no, I don't really have any auto expenses. I'm like, well, yes, you do. Maybe you drove to the bank, you open your bank account, you're taking care of banking transactions. You drove to the store to buy, your printer or your ink for your home office printer, etc. So there is usage, or even clients that are maybe driving from home to a go station and then they're taking go to get to work. All of that commute is being calculated. Now, yes, if we're talking about you're going from home to home office to a client site, it's easy enough. You calculate what the commute is one time, twice a day, X amount of days that you're working. That's the easy part. The hard part is all the other usage of your automobile. And there are actually phenomenal tools to help you. So in fact, QuickBooks Online has the tool which allows you, once you have your locator on, just like how you have your Google Maps, right? And it'll tell
Right.
you where you're going and
A
your
little
direction.
mileage tracker for you.
It tracks it. So every time that you're using your automobile, it will tell you, is this for personal use or is this for business use? And it logs the kilometers. So there really is, I mean, technology is phenomenal that it's out there, that it just cuts down on a lot of time for clients, right? Even for the odd times that, sometimes clients say to me, well, I did drive around and do all these things, but I forgot to calculate the kilometers. I said, no problem. Maybe you knew you drove to the store and you have the receipt, you know the date. Go to Google Maps, right? Your location from your home office to the store, what's the kilometers, add that in, right? I mean, that's a little bit more work.
It sounds simple, but the problem is that's time consuming, right? You do that across the year. And I've seen many people actually lose out on deductions and automobile audits because they haven't kept a mileage log.
Yes.
And it's not worth the time and effort at 50 cents a kilometer to go back and do that kind of work, which is why using these tools like QuickBooks Mileage Tracker or Mile IQ, which is another one if you're not using QuickBooks Online, makes it so easy. The key is you just got to turn it on, because if you don't turn it on, it's not tracking you. But once you turn it on, it's going to start tracking you. And then the only decision is this business or is this personal? Because that's how you get that percentage of use, right? It's the business kilometers divided by the total kilometers. That's the percentage of use for the automobile expense, right? And the only way to figure that out is unfortunately to track it. But thankfully, there's technology to make this approachable, because this adds up for quite a bit. And like you said, it's not just going to the client site. It's going to the store, it's going to your accountant's office, it's going to your financial advisor, it's going out for meals and entertainment, which is that other percentage of use account, right? And the thing is, what I want to talk to people about now is just switching over to the meals and entertainment. As you said, we talked earlier about how you can move items that are events from business promotion, which is, the government's basically saying you're getting half the benefits, so we're gonna add back half of that expense.
Right.
And that's not up for debate. It's one of the rules that we have to deal with as accountants.
That's in stone. Yeah, it's applicable for everyone.
That's in stone. But I want everyone here to think about their business as a lifestyle. So every time that you're going out for a meal, you're networking, you're building relationships, you're helping your business to grow, which means all of those meals and entertainment are deductible either as advertising, because we're doing a big event, we're having a party where we're inviting everyone, or at least business promotion where, yes, the government does add back half of it, but at least that's allowing you to pay for that with money that's pre-tax. So you get half of it's deductible. The other half, which gets added back, is still, you're only paying for that with dollars that have been taxed at the corporate tax rate as opposed to your personal tax rate. So, big advantages to maximizing these deductions, because every dollar that you're able to deduct as a business expense is a dollar you pay zero tax on. So we really want to help encourage you to maximize those deductions, and to keep track of everything. And that's why we love tools and technology to make this process easier, whether that's a mileage tracker,
100%,
or Dext for tracking the receipts for these meals and entertainment. Because at the end of the day, we can put in whatever we want into these returns. If we don't have the documentation, whether it's a mileage log or the individual expense transactions to support that, CRA comes knocking, we can't defend that and win those deductions.
I've seen clients back in the day with an Excel with every day that they've traveled
Oh
and
yeah.
calculating the kilometers for each day. I mean, just looking at it, I feel pain for the person who completed that. So I mean, when you really think, and again, going back to when you're utilizing these outdated methods and tools, you're less likely to be spending the time and to be doing a good job because you're
Yeah.
tired of it, right? You're
Yeah.
tired of, oh my God, it's like, X amount kilometers and I got to add this and I got to add that. So many times clients just skip it. And again, the whole thing of all those little things, they do add up. Right. So it is so important that you're utilizing the tools. I know, even when we talk about different tools, a lot of clients, the first thing they like to think about is, well, there's a certain cost associated with these tools to help you. But you got to look at it more than just cost. It's cost versus benefit. How much time are you
Yeah.
spending on this versus the time you could be spending to generate income on your business? Clients need to put a value on their time as well, right?
Absolutely.
Getting those tools to help you makes it easier to run your business. And I always tell clients, again, when we look at these tools, they're helping you to organize your finances,
Yeah.
right?
Yeah.
And it's also helping us to be able to have a better understanding of your business, to be able to give you the optimal tax planning, and all these different things, right? So yes, the automobile, I think, is the one that clients struggle with the most, because it's a little bit more, it is something that has to be done on a regular basis, right? And then of
Right.
course, again,
The
as you said it, sorry.
whereas with
Yeah,
the home office, once you do it
it's
once, odds are
different.
you're not moving every year. But
That's it.
it's interesting enough though. This is the home office I find is one of the areas where there's a lot of usually opportunity that people don't recognize because they'll
Very
just
much
say, "Hey, I have one room that I use for an office. Divide
so.
that by the number of rooms," which is one way to do it. And that gets a deduction, for the average person, maybe 10%, something like that. But usually with our formula that we use, which looks at things a little bit differently and uses square footage,
Mhm.
and adds in, things like the garage, which you're probably using to store the
Yeah.
vehicle that you use for business,
Or
but
maybe
removes,
basement, you maybe have a couple of items that you're storing in the
yeah,
basement, Yeah.
storage is another thing. And then removing out the common areas.
Mhm.
And by using this slightly modified formula, we end up taking those people who are 10, 15% and bringing them out to 25, 30% deduction, which on a home office, doubling the percentage is a huge increase because you're talking mortgage interest, you're talking property
Property
taxes,
taxes, your
utilities.
utilities, yeah, it
It's
adds up.
usually one of the largest individual expense items for most independent contractors. So if you can, increase that by 50% or even 100% in your percentage of what you're claiming, that's a big difference in what you're able to save.
Mm.
And so we've got a specific formula that we use. So come and talk to your account manager about what that looks like. Again, Rachel, as you said, the good news is, once you've done that, odds are you're going to be in the same house for
Yeah,
a
you're pretty
number of
good.
years.
You're pretty good.
Yeah.
Yeah.
The
I know
the
a lot
big
of clients,
I
sorry, I
just
know a
want
lot of
to
clients too, they are afraid in terms of maximize on that square footage, right? So that's also something where I tell clients, don't let fear dictate that. If you have a client come into your home, Andrew, if I'm coming to your home office, I'm not just morphing into that little office space, right? There are common areas that I'm using. So that's why I tell clients it's okay to include those as well.
yeah. And I think one of the other things too is that there is one caveat here though, is yeah, you're right. Don't be afraid to do it, but just be conscious if you do own your own house, you have a capital gains exemption on the sale of that house. And we never want to put that at risk. And in fact, taking and claiming a home office deduction does not put that capital gains exemption at risk as
Mhm.
long as the percentage is less than ancillary use. And so, what is ancillary use? It's not anything specifically or defined in the Income Tax Act. Uh, Generally speaking, as a rule of thumb, we use, about a third. If you're claiming less than a third of the total home as your percentage of use, we consider that a fairly safe. We have seen people go higher, but if you're going above the 30, 35%, we're probably going to have a conversation, be like, we want you to maximize those deductions. But as the famous expression that we have around here is, pigs get fat but hogs get slaughtered. So you don't want to get slaughtered. You want to get
So
fat.
true.
Yeah.
The other thing
Um,
as well, too, Andrew, is that also even with the mortgage, expense, it's very important that clients know it's the mortgage interest, not the
Yes,
mortgage principal that you are deducting. A lot of clients,
good point.
they could include that, but you really can't. So that's another one of the exceptions.
Yeah. And if you rent and you don't own, then we're taking a percentage of the rent expense. And then also if you rent, that capital gains issue that we talked about earlier goes out the window. So if you're actually using 50, 60, 70% of that
Mhm.
for your office, unlikely but possible, then you can claim that full, amount without any worry about capital gains exemption issues.
Mhm. Mhm.
Um, but I guess one other thing is because one of the things that you could have on here would be repairs and maintenance that you might also
Yep.
have in your home office, which sort of somewhat ties into is something a repair and maintenance, or is it a capital item?
Mhm.
And what is a capital item, and where do capital items get expensed if we're not able to expense 100% of them in the first year? So first of all, let me define what a repair and maintenance is. So repair and maintenance for your home is something where you haven't changed the value and you're just maintaining it, the home up to its original condition. That can include a large expense like a roof, right? Like if you redo your roof, it might be 15, $20,000.
That is
Um, but
expensive.
but you're just maintaining the home. If you take out hardwood, old crappy hardwood, and replace it with brand new shiny hardwood, you're actually still just considered repairs and maintenance because you're just bringing it back up to its original condition. Now, if you take out carpet though and you put in hardwood, you've changed the value, and that's now a capital improvement, and would
Upgrading.
need you're upgrading it. Let's say you take out a deck and you replace it with the same size deck. The repair and maintenance, you take out a deck and you put in a bigger deck. We're now into a capital improvement. And capital improvements, which if you own, we would probably discourage you from claiming because of this capital gains exemption issue. But if you had capital items that you're purchasing, like big furniture or equipment for the office space, these are assets that are going to have a useful life beyond the current year. And for those items, we actually have to amortize or depreciate those items, which I know can be a little bit confusing for people who've never understood this concept before. But don't the good news is you don't have to actually worry about like what percentage we claim and how we calculate that. We as your accountants will do all that for you. We just need you to say when something is a capital item and when something is an expense. And it's relatively simple for us. We use a guideline for our clients, which is basically if it's over 500 bucks
Mhm.
and it's going to have a useful life beyond 1 year, that should
Mhm.
be capitalized. And that's either capitalized as office furniture or office equipment or computer hardware,
Years, yeah.
yeah, or even computer software. Sometimes, although that's becoming less and less common as more and more people are moving to a monthly subscription-based services like QuickBooks Online as opposed to, QuickBooks Desktop. But if you're spending more than $500, then what will happen is we will claim a percentage of that each year, and that percentage is calculated by CRA or determined by CRA. They have different classes, and there you can think about these things as we said is in the categories we talked about: office furniture, office equipment, computer supplies, vehicles, those types of things. And basically, CRA gives us a percentage that we're allowed to deduct each year, and it's for almost all of them. It's a declining method, so which means we'll take, for example, let's take an automobile, for example. We'll take 15% in the first year and 30% of the remaining value in each subsequent year. We'll figure out all those calculations. We'll do all that funny math. You just have to tell us anytime you purchase or sell one of those assets.
The other
Um,
thing too, Andrew, with those assets that are depreciated over extended period of time, it's not a flat calculation for each asset. So something that will have a, like, let's say, as you were mentioning, the software, let's say you're buying, top of the line software, you deduct 50% the first year and 100% the next year. So CRA calculates it based on how long they think the lifespan of that item would be. So something like, for example, office furniture that you will have for an extended period of time, you only deduct, over the extended years, it's only a 10% deduction. So CRA does kind of gauge according to what the item is that they think the lifespan would be, and then determines a percentage of each of those classified deductions.
Yeah, and there are some new rules for accelerated methods and some
Mhm.
new rules for electric cars.
Electric
Again,
cars, that's a new
you
one
don't
too.
need to worry about all that junk. You just need to tell us what it is, and we'll do the rest. And like I said, our job here is to help you organize your finances, create wealth, and transform wealth into a legacy. And one of the things that's key to helping you build that wealth is keeping you out of having to learn all this mundane baloney that we got to deal with. We're here to just help you organize that information, and then we'll take care of the heavy lifting so that you can focus on building your business, and creating wealth and transforming that wealth into a legacy. So on that note, I think that probably brings us to a wrap on percentage of use accounts, unless there's anything else, Rachel, you think
No,
we've missed.
we've covered a lot.
Excellent. So we'll be back again next week with another episode. Please make sure to come back and check out all the amazing episodes that we'll be loading into this podcast. Let us know if you have a specific request of content you'd like to see. And I think we're probably even talking about maybe bringing in some guests into this podcast in the future.
That would be pretty good. We did have Karen join us some time back. So yeah, it will be nice to also have some, fresh faces and, to be able to chime in and join us.
Awesome. So I'm looking forward to those guests, and I'm looking forward to chatting with you guys next week. Thanks, everybody. Bye for now.
Thanks. Have a good one.